We have Bob Korajczyk here from Northwestern. Talk to us about high frequency market making to large institutional trades. You got 45 minutes.
Okay, thanks, Rob. Well, thanks for the invitation to come and present. My co-author Dermot Murphy is here as well. And I'm looking forward to your comments. This is the first time we've presented this anywhere, so Rob, you're gonna have to keep me in terms of time. All right. So we want to look at how high-frequency market makers. So we're not looking at all high-frequency traders, but ones that behave like market makers behave around large institutional orders or large orders. So we're looking at Canadian equity markets because that's that's where the data source that we have is. And we look at designated market makers that have some obligation from the industry group to provide quotes on both sides, contribute to the depth of market, and maintain market activity, and high-frequency traders who act as market makers. So those are the groups we're looking at. They're not mutually exclusive. We actually look at an incident where several stocks that have the market maker, the DMM changes from non-high-frequency trader to a high-frequency trader. So we might ask, how do they respond to large trades? What we define as a large trade is over $1 million, and an extra large trade is we look at over $10 million in one day by one client. So we want to ask how these HFTs respond to large trades. How do they respond to what we call stressful trades, which we define. There are lots of ways you might define it. The way we've chosen is to choose the top 20% of take a day stock event. So take a stock on that day, the top 20% size trades we're going to deem as stressful. And we want to ask how they change behavior during stressful periods. We also look at what happens when an HFT replaces a non-HFT as a DMM. And then how does HFT and DMM behavior affect implementation shortfall on these large trades? I may run out of time, so I just want to give you a snapshot of the results that we have. First of all, HFTs collectively supply a relatively larger amount of liquidity to large trades than DMMs, but they do that particularly for high volume stocks. And then when a stressful trade comes through, they back off from that liquidity provision more than the DMMs. Actually, the DMMs provide a little bit more liquidity for stressful trades, and the HFTs back off from that. Although the DMMs don't make up for the difference, so other traders in the market besides the ones that we've deemed as market-making HFTs and DMMs are picking up the slack. We look at it one day in time where the DMM for 24 stocks switches from a non-HFT to HFT, and we find that there's higher liquidity provision ex post for non-stressful trades in high volume stocks, but lower liquidity provided to large trades otherwise. Over the life of a large trade, HFTs net trades accommodate the order initially. So if this is a buy order, HFTs are selling, but that rapidly switches. So after the initial part of the trade, this is a trade using, what I'm calling a trade is really a trade package that's executed using many orders and many individual trades. And then, so the HFTs switch to competing with the order fairly rapidly. So if it's a buy trade, they sell initially and then they start buying, particularly passively. Over the life of large trades, the HFT abnormal passive buying and selling volume tends to be positive in the direction of the trade and negative on the other side. Okay, so that is they're competing with the trade generally fairly quickly after the initiation of the trade. And the same thing happens for order submission. Implementation shortfall, this is fairly commonsensical, is negatively related to liquidity provision by HFTs and DMMs and the time taken to execute, and positively related to the aggressiveness with which HFTs and DMMs execute over the trade horizon, the aggressiveness of the client that's executing the trade, and the trade size. So the data, we have order level data on Canadian equities. This access is provided by IROC. It's for 18 months, January 2012 to June 2013. So we have broker IDs and client IDs. So this is unique to broker-client combinations. We're not able to track clients using multiple brokers. I can't tell that the same person is trading with broker A versus broker B. So we're going to maybe misidentify some things. Also, if a client is using two different IDs with the same broker, we're not able to identify that as the same person. We haven't been able to do that. So we get a variety of information about the order, security ID, time and date of order, the millisecond, price, quantity, obviously the client ID, whether a trade actually occurs, is it order, is it canceled, are there amendments? And when there is a trade, there's an indicator of which side of the trade is the demander of liquidity, which side of the trade is passive. So how do we determine who are our HFTs? I'm sure we're going to miss some HFTs, so we're looking for HFTs that behave sort of like market makers. So we want them to trade a lot, so they're highest 20% of all. So take a given stock day, we'll identify someone as an HFT in that stock for that day as someone that has the highest 20% of all trades in that stock for that day. The net trading, so we want them to be sort of flat over the day. So net trading, less than 10% of daily trader volume. So let's say they trade 1 million shares. Their net exposure at the end of the day is less than 10% of that. Order to trade ratio greater than 1, and we want them to be sort of market making HFTs, so at least 20% of the trading is passive. So there are some HFTs that we're not including in this, which are someone that's trading totally active. They're not our market making HFTs. Then we say an HFT is a market-making HFT for a given stock if they meet these above criteria for 75% of the days as they trade the stock, and that happens for at least 20 days over a sample. So we identified 28 market-making HFTs. 4 of them we call super HFTs, that they're an HFT in over 100 stocks. There's 11 majors, so they're in HFT in 10 to 99 stocks, and then 13 minor HFTs. This tells you a little bit about their behavior. So the super HFT on average are in 196 stocks. They trade about 18% of the volume in those stocks. The order to trade ratio on the average is 14. They're aggressive in 21% of their orders. So the rest of the trades, 79% are passive. Their average end exposure at the end of the day relative to total trading volume is about 4%. And they're designated as an HFT in 87 days for that average stock. And you can see that how that changes across major and minor HFTs. So how do we designate a designated market maker? Designated market makers can, one of their obligations is to fill retail size trades, odd lots, and so forth. So they are able to designate, turn on this autofill, registered trader autofill to automatically fill certain types of orders. So anyone that has that, uses that designation, we say is a designated market maker. Usually that identifies one DMM per stock. Sometimes a primary DMM can have a secondary take over from them, so sometimes we get more than one DMM per stock. So we have 251 stocks for which we identify, since we want to compare HFT and DMM behavior, 251 stocks for which we identify a HFT and a DMM.
Now, do the DMMs trade on parity up to a certain amount of quantity in Canada, or do you know? Do they violate time priority and just join the quote, or do they have to wait in the queue?
I'm not sure. I think they
No, they can turn on this registered trader autofill function, and they can get priority.
Okay. Are they capped at a volume?
So under certain circumstances, it's not, they cannot turn it on at will. They have to, it's, if they have a certain inventory.
Yeah, there's for each stock has an autofill quantity, so I don't think they can autofill more than that autofill quantity. So it could be 100, it could be 1,000, 1,100, something like that. So the sample, we require a trade on each day in the sample. We require HFT involvement in 90% of the trading days and DMM involvement in 90% of the trading days. And that gives us these 251 stocks. Here's just some data on stocks, HFT behavior and DMM behavior. So the first 5 entries are just particular large cap stocks. So just to give you an example, and then we sort of aggregated across thirds in terms of average volume, high volume, mid volume, and low volume. So HFTs, P-vol is how much passive volume is accounted for by HFTs. So about 39% of stock one's passive volume is by the HFT, or 39% of the volume in that stock is accommodated by the HFT passively. 9.2% of the actively. They represent 43% of the orders in that stock. Of their transactions, roughly equal percentages, they represent equal percentage of the buys or sells in that stock. The order to trade ratio is 12, and for that stock, the HFTs have an ending position of less than 1% typically. DMMs are much smaller. So the DMM in stock one roughly is passively accommodating 2.5% of the volume, is actively accommodating 1.6% of the volume. So their percentage of orders is much smaller and so forth. So the DMMs are operating at a much smaller level than the HFTs, which, there are multiple HFTs in many of these stocks. So how do we classify a large trade? Aggregate dollar volume by a single client stock day combination above $1 million. And we call extra large trades anything above 10 million. So we take a client ID, and if they trade in the same direction for at least $1 million, that's a trading package that we're going to call a large trade. We'll see how that's accommodated over time. So for large trades, here's some statistics. The mean size is 2.34 million. It's broken up into 300 and some trades, 452 orders. The client, so this is from the client side, the person executing this trade, they, on average, demand fill half of that with, or 56% of that volume through aggressive trades, and the rest in passive trades. Average time to completion, a little over 3 hours, and the average implementation shortfall is 12 basis points. For the extra large trades, obviously things go up. The values of 17 million. There are a larger number of trades, larger number of orders. The percent active is about the same, and it takes a little bit longer to complete. The implementation shortfall actually increases considerably to 21 basis points. We also have what we call stressful trades and non-stressful trades. A stressful trade is in the top 20% for that stock for that day in terms of size. So the non-stressful trades are on average 2.5 million, whereas the stressful trades are 3.7 million. And so it takes the stressful trades usually have a number of sub-trades and orders that are larger. Liquidity demand is about the same, and a slightly longer complete or time to completion. So what we define is HFT liquidity and DMM liquidity provision. So this is the passive dollar volume of the HFT as part of this aggressive dollar volume of the trade package by the client. And the same thing for the DMM. And we do this for trades with at least 10% and at most 90% of volume executed by aggressive orders. If we drop the 90% cap, it doesn't really change the results. But we want, in order for the HFT to provide liquidity, we have to have some aggressive trades by the client. And what we show here is what's the liquidity provision by HFTs to large trades. So the dependent variable is HFT liquidity and DMM liquidity. So here's for HFTs. So let's we look at this middle column, column 3. The HFTs provide to high volume stocks essentially the sum of 12.82 and 14.6% percent liquidity. So we're providing about 27% of this large trade is accommodated by liquidity provided by the HFTs. If it's a stressful trade, the HFTs tend to back off a little bit. If it's a high volume stock and stressful, they back off by more. So for high volume stocks, they're still providing more liquidity, but for high volume and stressful, the effect is this 14.6 times 9.75. The aggressiveness here is the percentage of the client's trade that's aggressive from the client side. So obviously, this could go on either way depending on sort of endogeneity. The longer the time it takes for the trade, the more liquidity HFT provides, and actually the larger the trade size, the more liquidity is provided by the HFT. And this is just a graphical representation of that. We see that HFTs tend to provide more liquidity for high volume stocks than low volume stocks, which makes sense. They're high volume, high frequency traders, so they like volume. But they tend to back off, particularly in the high volume stocks, for these stressful trades. So when the trade is big for that particular stock day combination, the HFTs tend to back off in terms of liquidity provision. Here's the same table for DMMs. What we see is this, again, much lower liquidity provision by the DMM relative to the accumulation of HFTs. They actually accommodate stressful trades a little bit more than non-stressful trades, and then they accommodate high volume trading trades and high volume stocks a little bit less. So what we see here is that the DMMs are providing more liquidity to low volume stocks than high volume stocks, and that they're providing a little bit more liquidity to stressful trades than non-stressful trades. Okay, but the scale is different across this and the HFTs. This is not enough to make up for the backing off by the high frequency traders. So we look at one date, November 26th, there's the DMM changes for 24 stocks from there were numerous DMMs prior to that date that were all non-HFTs, and then there's a single new DMM, which is a high frequency trader. You can sort of see here are just 4 stocks that show you what's going on with trades by the DMM. Here the orders are 9, 9, 8, 14, 10, and then 13,000, 14,000, so on and so on. So there's a definite change in behavior here, and it's sort of consistent across most of these stocks. So we ask, well, you know, if we take the combined liquidity provision of the old DMM plus all the HFTs and compare it to the HFTs afterwards, since the old DMM is no longer isn't an HFT, what happens? And so the new DMM is just a dummy, the switch in the DMM for these 24 stocks. And we get sort of insignificant results for just the dummy, and it interacted with stressful trades. But we do see that there's higher liquidity provision for the higher volume stocks. So the biggest effect of this new switch to DMM is for the high volume stocks. But for those high volume stocks, they also back off more in liquidity provision when there's a stressful trade. And so that's shown here. This is before the HFT DMM switch, and this is after. And we see that liquidity provision is sort of lower in every case except for high volume, non-stressful trades. So HFTs like high volume, but they don't like sort of large trades for that stuff. So the next thing we look at is net trading behavior of large trade by the HFTs around large trades. So we take the duration of any given trade and split it into time deciles and ask, well, you know, how many shares are passively bought versus passively sold by the HFT relative to its total shares passively bought and passively sold. And we do the same thing in terms of shares aggressively bought minus shares aggressively sold. So think of this as sort of a passive order imbalance and a aggressive order imbalance for the HFTs in aggregate for this. So it's for trade, for decile D and trade T. So, and then we just average those across trades and deciles. And this is what we see on in the upper part. We're looking at the reaction around a stressful buy. Okay, so we're looking at these stressful trades, and the green is the aggressive trade imbalance, and the purple is the passive trade imbalance. And what we see, so what I mean by stressful buy is that this is in the upper quintile of that a trade size for that stock day, and it's a buy by the client. And what this is showing is what the HFTs are doing, and the HFTs have a negative order imbalance right at the beginning, which is they're accommodating that buy, they're selling, but they're quickly turning around and they're trading on the same side of the trade. Okay, so after the first decile in time across this trading package, they're buying. Okay, when it's a buy, and we see sort of the reverse down here. The red line is passive trade imbalance, and the blue is aggressive trade imbalance around a stress sell. And what you'd expect is, you know, they're going to have some limit orders on the book. This sell comes through and by the client, and they're going to buy. So their trade imbalance is positive. They're buying here, but that doesn't last long. Okay, by the time you get the second decile in trading time for these trades, they're trading on the same side of this particular order. So they're competing with the trade and executing on the same side. How am I doing on time?
You got another 20 minutes.
20 minutes. Come on, let me try to start. The next thing we look at is sort of their trading and order placement relative to what we call normal. And how do we define normal? So if I think about this decile, of trading time across these trading packages. We're going to ask how many shares this is abnormal passive buying and abnormal passive selling. So how many shares did the HFTs passively buy during that decile, trading decile, time decile? How many shares did they passively sold? And our benchmark is, what would they normally do? And it's admittedly a crude benchmark. We take the lag moving average over the last 60 days of the HFTs trading in that time of the day. So if if that decile is 12 to 12:15 on Tuesdays, we're going to look at last 60 Tuesdays. Is it 60 or 30? 60 at 12:15. Okay, so it's a daytime matching, and we just take the average of that. So we're going to ask, are they buying more than they normally have in that period, or are they selling more than they normally have? And again, this is passively, and we'll look at orders. Okay. And we split it by stressful trades and non-stressful trades. The top two curves are non-stressful trades, and what we see is they seem to be both. I'm missing this dotted is HFT passive buying during non-stressful trades. The dashed line is passive selling during non-stressful trades. So they're doing more of both, and maybe they're doing more of both because there's a large trade, and there may not have been large trades in that on average during that past period. But it's pretty balanced. I don't see any. They're not doing more or less of one versus the other. Here, this is telling you a little bit about how the client is trading this trading package over this interval, and they tend to trade more at the beginning and more at the end and less in the middle, and so you sort of see the HFT sort of mirroring that as well. Now, when we look at stressful trades, I think we see some pretty interesting results. Is that so? This is during a stress. This is during a large buy by the client, and so this green line is passive buying during a stressful client purchase, and this is stressful. This is HFT passive selling during the large buy. So basically, they're doing more buying passively than selling passively when there's a stressful buy on by the client. So again, they're competing with the trade. They're executing on the same side as the client is trying to execute. The next figure 6 is what happens during large sells or stressful sells. Again, just the non-stressful large sells. Again, we see sort of matched passive buying and selling. So there's not really imbalance. And for the stressful ones, we sort of see, again, this is passive buying and this is passive selling. So we see right at the beginning, the client is selling and the HFTs in the aggregate are buying an abnormal amount, but that declines. They're still buying an abnormal amount through this, but they're selling an even larger abnormal amount relative to what they typically do. So they tend to accommodate the trade during the first decile, and then they sort of switch, and they tend to be more on the same side as that client's trade than on the opposite side over this decile. Again, the trading tends to if they were just doing some sort of VWAP trade, you would tend to see this kind of behavior as they're just accommodating the volume going through the market. So we've done a similar thing. This is just passive buying and passive selling. So these are actual trades. So we've done a similar thing with just orders submitted. So we look at buy orders submitted, both active and passive, or by time decile for that trading package. And we sort of, the benchmark again is this lag moving average of total shares and buy orders submitted in that same day time period over the recent past. And this is the sell orders submitted. So this reflects not only things that get executed, but things that don't get executed. And we see a very similar picture for these are again for the client is in the market buying. They're doing more buying and they're submitting more buy and sell orders, but sort of equally to accommodate, and maybe to accommodate this partially. But what we see for the stressful trades, we see abnormally high buy volume, particularly at the beginning and the end of the trade, and we see high but not as high sell, not volume, but sell orders being placed that become negative. So they're, again, what I mean by negative, it's less than they've done in those periods in the recent past. So again, they seem to be buying more when the client is buying relative to their sells, particularly for these stressful trades. This graph, figure 8, is for order submission during the client's selling. So again, we see almost identical stuff for the non-stressful trades, but for the stressful trades, we see that the HFTs tend to be, their sells tend to be jumping up more than their buys. Okay, so again, not sells, but sell orders and buy orders. So these are order submissions, and so you see more, a bigger jump in sells than in buys. In fact, the buys are abnormally negative. The abnormal buys are negative until right at the end. So again, they seem to be doing something that people have been worried about, is that they're somehow identifying these large trades and trading in the same direction, competing with the trade. So we also want to look at implementation shortfall. We define what HFT liquidity provision and DMM liquidity provision was earlier. Is how much active trading did they do relative, how much passive trading did they do relative to the active trading of the client. Here we're defining how aggressive they are. So what's their active dollar volume relative to the client's passive dollar volume. So how much of the client's passive dollar volume is being accommodated by the HFT and by the DMM. This is, we're getting things that, again, I think are pretty intuitive. If the HFTs and the DMMs are providing liquidity, implementation shortfall is declining by a significant amount. In fact, these quantities are not that disparate from each other. So these are for all trades and for large and extra large. If the HFT and the DMMs start accommodating more trades aggressively, then implementation shortfall goes up. So it becomes more costly to trade again. The quantities are pretty similar across HFTs and DMMs. There's more significance for the HFTs because there's more data there. This aggressiveness is what's the fraction of the trade that the client executes aggressively. that's positively, you'd be surprised if this wasn't positive, I think. Well, there's some endogeneity issues, so they could say, when the market's more liquid, I'm going to execute more aggressively, but we get this positive relation. That's significant. Implementation shortfall is declining in the length of time the client takes to execute the trade, is increasing in the trade size, and is the smaller for mid-level volume and high volume stocks rather than low volume stocks. So that's, I didn't think I was going to get through it.
Did good.
Let me say a little bit about our conclusions. HFTs in this market are supplying, at least the HFTs that we've identified. We don't claim to have identified all HFTs, so there are more HFTs out there than we've located. So the one we can't say much about what those high frequency traders are doing relative to these, but of the sample that we have identified that do provide some liquidity to the market, they're providing a fair amount of liquidity, but they back off from stressful trades. When we switch from a designated market maker that is a non-HFT to a high-frequency trader for 24 stocks at one point in time, that increases liquidity provision only for the high-volume stocks. So again, HFTs like high-volume stocks. So that increases liquidity provision. It decreases liquidity provision for low volume stocks, but that decrease is much smaller. HFTs trading around this trading package, if you look at the time scale of this trading package, they initially accommodate orders. So if the client's buying, the HFTs are selling, and if the client's selling, the HFTs are buying. But by the second decile, so after 10% of the time of this trading package has elapsed, they are now trading on the same side as the client, on average. I mean, they're doing both, but net, they're doing more on the same side as the client. For stressful trades, abnormal passive buying and selling volume tend to be positive, so they're doing more buying. Abnormal buying relative to what they've done typically in that daytime period when the trade is a buy, and doing more selling when the trade is a sell. Same thing with order placement, both a passive and active order placement. Implementation shortfall is significantly related to what the HFTs and DMMs are doing in pretty commonsensical ways, that they provide more liquidity. Implementation shortfall falls. If they're more aggressive, it rises. The bigger the trade is, the harder it is to get, the higher the implementation shortfall. There are lots of, we have one definition of what a stressful trade is. It's sort of big for that stock and that day. So for some stocks, a stressful trade is a much smaller trade than for some other stocks. We're thinking about, well, one of the things we're working on now is, so how profitable are these high frequency traders? And for example, if they've been losing money recently, so there's a stress not defined by the trade itself, but it's a stress defined by what's happened to the high frequency trader recently. So we're trying to take a look at that. Another way of defining stress is, well, not only, we've sort of looked at it trade by trade, but it could be that there are, a day when there are 3 stressful trades going on simultaneously is a different day than when there's only 1 stressful trade going on simultaneously. We haven't sort of done that. We can possibly expand the set of types of HFTs that we look at. We could also condition trade characteristics or liquidity provision by the HFTs on the state of the market at the time. So do they behave differently depending on what the spread is, and things like that. So we think it's a great data set to work with, but it takes some time to sort of go through and construct all these things, and there's a lot more to do. But looking forward to hearing people's comments, and thanks for listening.
About what he did.
A quick question. I want to understand a little bit more. So I execute for large institutions, and frequently we use algorithms and VWAP, et cetera. And so for me, it's very important. I love watching how you're trying to examine implementation shortfall and whether an HFT, is being aggressive or aggressively providing aggressive along with the trade or passive. So my question goes to how you and academia generally perceive aggressive versus passive. Are we just talking about whether you provided the liquidity or you reached across the tick and took liquidity?
That's how we're defining it. So if your trade executes against a standing limit order, so you put in a marketable limit order, you're the aggressive side of the trade, and the person whose limit order was sitting there is the one that's passive or providing the liquidity. So that's how we're defining it.
Now, is your implementation shortfall really just effective spread because there's no unexecuted portion of the order that you're marking to market? It sounded to me like it's effective spread versus the first quote benchmark. Is that right?
Right. So
it's really no cleanup. So some of your, and I'll be quiet, but so it's really an effective spread, not implementation shortfall, as you measure it.
Right. So we don't see what the trader wanted to trade.
That's right.
We only see what the trader did.
So there are no cleanup costs associated with that.
So yeah, absolutely.
All right. Next we have Malye. Did you flip a coin to Hans to see who was first?
Okay.
Did you?
I don't.
I mean, Hans, would you rather go first? No. You got 12.
I won't go first on this.
Well, that doesn't mean you get to go first.
Okay, I'll say, did you go?
He may pay me $20.
Oh, okay.
You got 12 minutes.
Do
He wants to comment on your comments.
You got till 2 up there.
Okay. First of all, thank you very much to give me the opportunity to first discuss this paper. Okay. So this paper actually asks a very interesting and important question. It's like we know from the literature, it's like lots of work done by my friend Jonathan Brogard. It's like a high frequency trader increase liquidity in normal times. But then there's a natural question: is like what do they do during stressful times? And this is an important topic because, as I said, most papers in this literature talking about normal times, and there are very few working on the stressful trades or large trades. And why it's important? Because it's important to the literature. And the second thing is it's also important for policy making. Because there are also debate whether should we bring designated market maker back to the market. Is that benefits the market? So I think this paper asks a very interesting and important question. So here's main results. So I divided main results into 3 parts. First one is based on large stressful trades. So the paper is based on large trades. Stressful trades are even larger trades. So what Bob and his co-author find actually is the percent of liquidity provision from a high frequency trader decreases. And the percent of liquidity provision from designated market maker slightly increase. Okay, that means actually they do not sum to 100. So I infer one information is like a liquidity provision from other type of trader actually increase slightly or increase, right? So then at volatile days, we also see a decrease in percentage of liquidity from HFT, okay? And also implementation shortfall actually increases when the high frequency liquidity provision decreases. This is the 3 main results. So here are my suggestions for the paper. I only have 12 minutes, so I need to quickly go to this part. So first one is I think this paper make a really interesting contribution to the literature, but it can, in terms of writing, it can also be linked even more closely to the literature. And the second one is it will be interesting to propose alternative hypotheses for this paper. and then rule out alternative hypothesis. That makes the paper even more interesting. And the final thing is like beta identification. I think you have like an event about 24 starts, but we can implement that identification even in a better way. Okay. So first of all, I want to talk about like high frequency trading. Here is my summary of the literature. So the first channel is called price competition channel. So price competition channel tells what? So it's like HFT, because of their speed, they provide a better price of liquidity than non-HFT. Okay, that's the first literature. Why? There are two reasons. First, number one is like they may avoid pickup risk. And Jonathan Brogard recently have the paper showing they have better inventory management because of the speed, okay? The second one is called information channel. Information channel say that if you have speed, you automatically select other people, okay? So and also, I think this paper implies another interesting thing is like if you have speed, you can quickly back off from the market when there's a stressful trade. So you have some predictions. Also, Nick Hershey has some paper, indicates that. I think this one is slightly, it's related to this literature, and also that's a benefit to be discussed to share your own paper. But I have a paper, it's neither of these two, it's called tick size constraint channel. So what does that mean? That means HFT and non-HFT, they provide an identical price. It's because you cannot quote continuous price. So at some price level, they have to quote the same price. And the speed actually means that high-frequency traders have time priority over non-high-frequency traders. So it's not competition on price, it's pure competition on speed at constrained price. So then let's look at the main variable in this paper. So it's basically like we can understand that as a percent of HFT, a percentage of liquidity provided from high-frequency traders, right? So the change of this variable can have two reasons. First one is like HFT really back off. The second one is other type of traders provide relatively more liquidity. So then dilute the liquidity provision from high-frequency traders. Then that leads to several interesting stories which you can test. First one is like, look at the price competition channel. So the price competition channel tells you high-frequency trader quote better price than non-high-frequency trader. What does that mean? That means if you are a large trader, but not so large, you are here. Then high-frequency trader, let's say in this specific case, they provide 100% of the liquidity. Then it goes to a stressful trade. And then it's even larger. So the order can, in some cases, just hypothetical, this is a hypothesis, they can walk into the book and hit some non-high-frequency traders. So that means stressful trades on the price competition channel can lead to a higher percent of non-HFT liquidity provision during stressful times. This is a price competition channel. Okay, and price constraint channel, here's my story. It's like in US, I use US example, it's like one standard bid ask spread, which can be binding in some cases, but you can use big take fees to bypass that. But generally, sometimes it can be very binding. So then HFT can have time priority over non-HFT. If you have a small trades, then it hits HFT first, but large trades actually can go further away in the same price queue. So that means non-HFT can provide or some other types of, including like a designated market maker, they can provide more liquidity for large trades. Okay, and here's the interesting case. I think it's a mix of HFT backoff and tick size constraint. It's in the middle. So that means during stressful time, what happens is like tick size actually is less binding. And so you can see, you can interpret that in two ways. First one, you can see in stressful times, in this case, HFT actually provide a worse price. But it can be due to two reasons. First reason is like they really back off. The second reason is when tick size is not binding, when the spread overall is large, that means that creates price differentiation. So it's also another possible reason. So I think it's consistent. If we find that, it's consistent with this paper, and it can also consistent with tick size constraint. And the other, so look at these trades, okay? The other story is like they completely back off. Under some extremely stressful times, maybe we can see there's only non-high frequency traders. Okay, so what's the summary of that? So here's one suggestion. I think Bob had already mentioned that in your conclusion part. It's like, I understand this is a large data, and probably this is just your first step of analysis. But the next step probably is like, number one is like you can construct limit order books and test several alternative hypotheses, which relates your paper even closely to the literature. For example, if it's because stressful orders walk into the book, it cross non-HFTs, increase their percentage. Because non-HFT called worst price, it's only large orders who touch them. So then that's a support for price competition cap. And if you see like the stressful orders cross non-HFT orders with lower time priority, then that's pure tick size constraint. And if you think like HFT orders move to a worst price, and then you can compare whether non-HFT also back off, how much more they back off. Then that's a even more direct support of your story actually. And it's something also consistent with tick size constraint channel. And also, I think this is a case where sometimes probably during extremely large trades, there are uncertainty, they completely disagree. What's the case? So what is my suggestion? So there's an aggressive approach. It's like you can construct limit order books. But I really understand because I do that. It takes some time. It's easy to say they're done. I say that today. It probably takes you like 2 months to complete that. And also, so there's a first step I suggest. It's like you have already have the data. This is just a first cut test. I mean, it's just an indicator, but summary statistics on the trade price. So if trades executed with HFTs achieve better price, if you look at the sequence, I mean, just the summary statistics, that's consistent with price competition channel. That means you first meet HFT with better price, and as the order grow larger and larger, you start to meet people with worse price, which can be non-HFT. That's just like a hypothesis. I don't know because I haven't seen the data. Okay, suppose you can see, okay, they executed at an identical price, the same price, but HFT appear early, non-HFT appear later. That's probably consistent with tick size constraint channel. Okay, and if you find actually, here's the title. It's like trades executed with HFTs actually have worse price. That's another support of your story. It's like for stressful trades, actually they back off. They provide a worse price than non-HFT. So basically, my suggestion is like in the long term, you probably can start with this step. Simply look at all the trades because I know constructing limit order book, it's a daunting task. I mean, it takes forever. But if you see some pattern using the trades, I think that's already you can find some support maybe for your story. Okay. And here's identification. I think this paper has a nice identification. It's like for 24 stocks, and HFT becomes designated market makers. Okay. So we can have even better identification. For example, we can find control group for the stocks, which is not affected. And we can use matching sample. And also, I'm curious whether there's some dual class shares in this case. It's like maybe it will only affect one class of the shares. And here is also an interesting thing. I don't know whether you can get the data from US actually. It's like they're cross-listed shares. It can be served as the control group. Yeah, I'm on time. Okay, thank you. So here's the minor issues. I think Bob also mentioned that it's like one HFT can have multiple IDs. It's like multiple ID things. But I think it's you have already mentioned that it's like here's one concern is like different IDs of the same HFT may have different strategy. But I think this data is already much better than any US data. So that's the reason I mentioned it's a minor issue. I mean, because in US, the data quality is not even, it's far below. Okay, so here's the summary. So it's a very nice paper. I think it examines the rule of HFTs in stressful time. I mean, the literature most focus on normal times, and this one is on stressful times. I think it have a contribution to the literature, and it has a rich data set. I know it's hard to understand to analyze this kind of data set, and lots of intensive analysis. So I strongly encourage you to read the paper. Thank you.
Good job. Hans Heidle from the SEC.
Well, thanks. So let's see if my PowerPoint works too. Good. First step. All right. First, thank you very much for inviting me and giving me the opportunity to discuss this paper and discuss Mao's discussion as well, I guess. I would have updated my slides, but I didn't get it, get it through General Counsel on time. But this is the usual disclaimer, I guess. You heard that from Mark earlier. I don't do it as often, so I'm not as skilled as it. Just whatever I say is my own opinion, and especially mistakes are mine, or stupid things I say. I think that's what the SEC really is worried about. So I will try to be quick on the summary because I think Bob already did a great job, and then Mao as well. Just, it does add to the growing literature on HFT, and I find it very interesting because the buy side does actually complain about the phantom liquidity, right? And not just since Flash Boys, I think it was already before out there. It's a rich data set. They can identify HFTs and DMMs, and they also are able to get institutional trades from it. But it is just an approximation. I think Bob already mentioned that. And it's nice that it focuses on institutional trades as well as the stress trades, and because in the end, that's, I'm not sure if I should say that, but it's really what's important. I mean, the bigger trades, institutional trades, that's really where you see the costs come in. And it's a Canadian market, so I guess, the NASDAQ HFT data set has been used a lot, so it gives from a different data set results. This one I really don't want to talk too much about, except maybe, this one, I'm not that surprised by that because, you already said that it's a whole different scale, right? Obviously, HFTs are much, much bigger than DMMs, so whatever DMMs do is not really that important in the end, right? Then, you've done a lot of tests and lots of results. And if I had 2 hours, I could go one by one and make a few comments, I guess. But one thing I really liked is this experiment when the HFT actually became a DMM. And Mao already commented on it as well. I also think you can actually do a little more there. As I understand or read your paper right now, you kind of argue that because the HFT is now a DMM, it brings more HFT to that stock, kind of. That's kind of how you view it. But the question is, did actually that HFT change his or her behavior by becoming a DMM? I think that would be a very interesting question to answer, and you can do a little more there, I think. Now, you didn't put that up, but it's also a disclaimer, I guess. The last sentence in your paper, the data do not allow us, however, to comment on the counterfactual of what trading costs would be in the complete absence of HFTs. I think that's a big point because would the DMMs really step up? Would they be sufficient without HFTs? Phantom liquidity, it sounds negative, but it's in good times and bad times. In good times, it provides lots of liquidity. Even in bad times, they don't disappear. They provide less liquidity, but it's still there. So the question is, would we be better off without HFTs, or is something not better than nothing, even during tough times? And I also was thinking about it because HFT is always, is it good, is it bad? I can't blame HFTs or DMMs or whoever to step out of the way in stressful times. Can you? I was. Then the other thing is, I'm not sure if DMMs are actually a good benchmark comparison because DMMs, they usually do get some benefits. In this case, it's a 70% break they get on the fees they have to pay. And then the question actually becomes, well, are the benefits justified by what the liquidity provided by the DMMs? That's actually the question there. And also, well, the D should be gone here. Market makers also have withdrawn during very stressful periods. 87, when they didn't answer phones anymore, financial crisis, and so on. So it's not just HFTs. Now, I should mention, I've been in industry for a few years, and I've worked a lot with transaction cost analysis and large institutional trades. So one thing is, why do you stop at a day? I mean, you can go with a client ID. I mean, they are multi-day orders, and they are very different very often. They're even bigger, actually, most of the time. And I also have to say, and I think I come back to that later, I mean, post-trade TCA is actually crucial in this space. And I get back to that a little later. The other thing is, there's a selection bias. What you see is large trades, they tend to be executed when market conditions are favorable. I mean, if markets really suck, they will not execute a $10 million trade. They just won't. So you will have a bias there. So the costs are too low for large trades. I do think it's a nice contribution, though, to use institutional trades, but I think a little bit what Mao said, a complement, why not look at other measures as well? I mean, for example, you take 1%, 2% of ADV, and you say you walk up the book or down. What the cost would be that? But of course, that would necessitate the construction of the limit order book itself. All right, so a little bit about how you identify HFT. I mean, I guess one difference to what NASDAQ did is you don't have any names, so there's no like cross-check by saying, oh yeah, this is an HFT for sure. You can't do that, which is fine. It's just something to keep in mind. And I'm not quite sure. Order to trade ratio greater than 1. That 1 seems a little low to me. I mean, I would have chosen a bigger number. Also, a little related to that. I mean, you do remove the most aggressive HFTs. And I guess you do it because you want to have market-making HFTs. You could actually be a little clearer in the paper about that, why you do it, and so on. The other thing I thought about is, what does it actually mean? So, who provides liquidity or not? So if I'm a pension fund and I place a limit order to buy, and now the HFT swoops in and hits my order with a market order. Now we're saying the market, the HFT took liquidity, but in the end, the HFT facilitated my trading needs as a pension fund, right? So that's also something to keep in mind when you say we exclude all the aggressive ones. I mean, one thing I noticed in table 1, this is order to trade ratio. When you have those two, that look quite different. I mean, why don't you break it out and run the analysis for those separately? Maybe they're different. As a matter of fact, it would be nice if you had a little more descriptive statistics for HFTs as well as non-HFTs on things like OTR or other characteristics. And actually, I give a shout out to Austin, who will speak later. You can actually form clusters based on certain activity metrics to try to figure out which HFTs or which traders behave similarly. All right, I got to speed up. Well, this is actually probably, you already mentioned that as your next steps, so you already know that. I mean, you use large trades as stressful trades, and well, one is, I'm not a fan of using dollars just there, because, I mean, you should look at ADV. I mean, $1 million traded in one stock is very different from another one. Then you just use, as I said, size for stressful. First, you switch it between quintile and quartile in the paper and presentation and paper again. Then actually in the presentation you call it the top 20% of the large trades. Yeah, that's how I would explain it. In the paper it's very complicated. It took me a while. I was like, am I missing something? And the biggest thing is only one dimension. Market conditions, especially stock momentum, is key. I mean, stock momentum is a driver of cost, and it's something you should look into. Now, one thing I noticed in your graphs, you know, when you looked over the course of a trade, you see this U shape, and that reminded me of the U pattern we see intraday. So I really wonder if the intraday patterns in volume might have something to do with this. And you know, is there variation in the activity of HFT, PMM during the day? And actually, just having the distribution of start and end times of large trades might already help it. or help me understand. If they all start at 9:30, then okay, then it might have to do with the intraday pattern. A few things here. I mean, your left-hand side is bound between 0 and 100%, and I mean, I would have done a logistic transformation. I know then the coefficients are not that easy to interpret anymore, but you have at least to get around some biases and stuff. Of course, most, if not all, of T sets are really highly significant, but you also have a really large n, so I don't know what to make of that. Controls for trade size, square term, little iffy on that. I mean, there are other functional forms that are used in industry if you want to do price impact. I mean, square root. Obviously, you have a negative sign here, and if you can get negative, so that's not good. But also what I saw is for DMM, actually, you have it the other way around, which is a little weird, and it was significant in it. So suddenly the price works the other way around. So I'm a little iffy on that. And most of the time, you actually add up coefficients to come up with your effect. It would be nice to see significance of those combinations, and sometimes actually the individual coefficients are not significant. And again, with large orders, with large sample, sometimes it's a little surprising to me, I must say. So subsamples, I would suggest. One thing is, even if you use relative order size, it's always not perfect either. Because if you take 1% of Microsoft, I usually use as a sample here, but I looked at that. Number one is Toronto's Dominion Bank, right now in Canada. It's very different from 1% of Chuck E. Cheese, right? Then why don't you run it for different liquidity groups? You already have. I mean, you have dummies, but it would give you even more control there. I also would look at different time periods. You have 18 months, you have lots of sample size, you will have lots of power. You can look at change over time, robustness check, and also if things are still significant if you have a smaller sample. Okay, those are a little nitpicking, I guess, but this one doesn't adjust for volume of the stock day, the abnormal stuff. So, I mean, yeah, so you abnormally higher, double than usual, but the day today is double. So, a normalized plus stock day volume. Then you actually have it in the paper at some points. It's important to distinguish between volatility and stock momentum, right? I mean, HFT love volatility, they just don't like the direction. I'm getting the hook. You could also look a little bit at exchanges. Across exchanges, there are differences. You have identifiers. I would use a mid-quote, not the first trade. Not identify your results, but it would be gameable, so nobody would use the first trade. Now, this one, you find that aggressive execution by HFTs increases IS, and you describe that by saying, okay, if I'm posting a limit order and that's getting picked off, I get bad prices and increase my amplitude shortfall. I don't see it. So if I'm an institutional investor, I post a limit order to buy, and I'm getting hit. It's adverse selection, fine, because prices actually tend to go down afterwards, but they will reduce my inflation shortfall. Yes, I could have gotten even better price if I had waited, but prices don't go up, so I don't follow that logic at all, even though the regressions say that's what it is. And the same thing is, you find that inflation shortfall is lower for higher volume stocks. I mean, that's kind of mechanical because you don't use ADV, you use dollar trade size. Okay. There's some other papers you might want to look at a little more. The last one you look at, but discuss a little more maybe. I have one more slide. Okay. Just this one. You could actually, looking at stressful times, it's actually a nice thing. And right now, that retail liquidity programs, you have changed it. It would be interesting what happens here during stressful times. Also, NASDAQ market makers, not the amendments, there was a thing they had to adjust actually their price gains across
you guys like to respond?
Yeah, first of all, I'd like to say thanks for all the fantastic suggestions. I mean, there's lots of things that we could do that came out of your discussions. With respect to the aggressiveness, that's the aggressiveness of the HFT to anybody over that trade. So it could be that they hit someone else before your order got executed. So it's not aggressiveness against the client's order. So that's what I think it might make some sense. Did you post it on the percentages?
I think so.
Well, but thanks very much. Actually, I'd love to get your decks so we can go back and go through things.
What I found interesting about the U-shaped comment was, a lot of our measures when we're looking at the graphs later are abnormal trading measures, so we're adjusting for volume in that same time period in the past 60 days. So the fact that we're still getting the U-shape doesn't really reflect the fact that there's more trading in the early and late parts of the day. It's more to do with the fact that, they're trading more or even less in that time period relative to those same time periods in the past. And then the order to trade ratio greater than 1 constraint, it's kind of a weird one, I think. But we put that in because there are traders that have order to trade ratios less than 1 because they submit a gigantic order, and then that ends up being, that displays in the data as a bunch of different trades, so they tend to have really low order to trade ratios. So we were trying to take care of the guys that essentially trade really big orders, and they trade in and out of those orders throughout the day. So they almost appear as high frequency traders, but what they're actually doing is trading in and out of very gigantic positions. So we didn't want to include those guys, so we put that order to trade ratio greater than 1 requirement there. But we'll clarify that more in the paper.
Robert?
I have one thing I was curious about, and it goes back to sort of Hans's issue with the family liquidity. You showed that in stressful times, the HFTs back off more. And I was curious if you look at the cancellations during that time period, you might hit the family liquidity, but they're pulling that away during that time period. And really what the difference between the stressful and non-stressful period is that they're canceling the trades that they're putting in during that time period.
We did look at orders cancellations as well. We didn't include that graph in the paper, but we find that orders and cancellations are really, really correlated, whether it's a stressful trade or not. I think we should still look at if cancellations just ramp up a lot more relative to the orders during the stressful trades. So we'd like to look at that. Yeah.
So it's very nice paper. So I have a general comments. One is, I think what we discussed mentioned as well, identification of HFT traders, right? Because in your measure, if a large agency trader that executes in always for clients, may well be identified as HFT in your case. Because they do trade both sides. Divided at the same time, right? So how do you classify HFT? You just working data activity that's a little bit problematic, right? The second issue is more on DMM. So you argue that designated market maker behave differently, right? So, but I think it's good to look at the cost and benefits versus obligation of designated market makers. So looking at obligation side, there's not much nowadays because the requirements are making close out there. Probably will surprise you if I can pick any stock in the US, I can become a DMM without trading any shares. You can easily do that actually, right? So on the obligation side, if I become a DMM, I will do nothing differently whatsoever versus my HFT, right? On the benefit side, there are 2 major benefits. One is designated order flows. In the US, you can designate order flows from retails, right? You have become DMM. Also in Canada, you can do the same thing through the auto-fill function. Can you do some study on whether those fields are good or not? Because for a trader, I can know that order flow is not toxic, helps me versus I can trade blind in the market. And just check out the benefits of that. That's one benefit. Second thing is the trading cost. US, if you are DMM or archives for leading market maker, so LMM was a DMM, right? In those cases, the take fee is lower actually than the movie. I can trade in and out the same price I can still make money, right? You can only become that if you are DMM. Right? So in your case, I think Canada has the same feature because they get paid annually by issuing company. So it may work out because if you don't make money, they can come back and pay me more, otherwise they are planning business also. So, but that works only for market where market is stable. in your case, in testing scenario, market is stressful. In that case, the benefits is so small, nobody will even trade it. So it will be interesting to Maria's comment. So where market is stable, do they improve liquidity? 2 cents spread, or are they willing to step in providing a new spread? That's more interesting than markets in stress conditions. Nobody really wants to trade because the benefits they get is so small. Doesn't help them to close the windows here.
I just had a couple questions about the institutional features of the market. And I first wondered is, do any of the market participants have obligations to provide continuous quotes? Do they allow co-location on the Toronto Stock Exchange? And I wondered if the designated market maker designation was publicly disclosed so that you could, if that was, you could actually go back and identify who some of these firms are that you're calling HFTs and see if they actually are HFTs.
Yeah, it would be very interesting to identify those HFTs, the ones that became designated market makers, because on the TSX website they have the list of designated market makers. There's about 15 or 16 different firms, I think. So I think you could probably infer who the HFTs were. I think we have to be a little careful with that.
Non-disclosure.
So you have stock A, B, C, D.
Yeah.
I mean, that's at the request of IROC.
And we used to have
because we wanted to be stealthy, but so they want to try to.
Yeah, I don't think you need a table saying who they are, but you could at least, for your own purposes and your own identification strategies, decide if you really are finding firms that are still HFTs that decide to become designated market makers.
And there's a link on our paper in one of the footnotes that goes to the TSX market maker definition. So it says that they're obligated to, continuously provide depth at the market at all times and so on. So they have a lot of requirements for a DMM that are a little vague when you read the website, but I think it's different across different stocks depending on the volume. So we've been asking about it, but it's different across stocks. But they are supposed to maintain bid-ask spreads, maintain market activity, maintain depth, and a few other definitions, I think.
And do they co-locate or co-locate?
I'm not sure about that one.
I've always wondered about that in U.S. markets, right? Because the so-called advantageous co-location, this is a market where you can still say, I want to speculate the same exact thing would happen. In a market where you eliminate the co-location, you just force the fastest people to still get inside first, and that just
We have a contact that we continuously ask questions to. We'll ask her about this as well.
I have a
Go ahead, then,
question,
Chris.
a comment, rather, Francis' comment about the identification of HFTs. I would also do the higher than 1 over the pay ratio because the way the trader IDs work in your data, you may have smart routes that are included because of the low over the pay ratios. And there are other ways probably that you describe to the order to cancel time and so on. And I have a general question on DMMs versus HFTs. So my understanding is on NYSE, for instance, many HFTs are DMMs. Do you know what features of Canadian markets they just don't make it work? DMMs in Canada participate very little seemingly. So, and I also, regarding the taker fees comment, there is a program called Electronic Liquidity Provider Program on Toronto Stock Exchange, which some of the large HFTs, I believe, are part of. So that would be also, if you're looking at HFTs, may make sense to look at small versus large.
Kumar has a paper that looks at that. At SMU.
The name is confusing because DMM is the name used by NIDE to refer to specialist. Your DMM definition is basically the ARCA union market maker definition, which application is there's 3 rules, I think, right? You have to just start with 6% outside the NBO. That way you need to bid, you don't even need to trade for 2 hours out, right? And
Right.
the rule is you have to be on the inside for a certain amount of time. That's also easy, right? But the rules are similar to this.
So Chris actually routed orders there, I think.
Yeah, I did. Just a quick note on that. So comparing the U.S. market and Canadian markets can be a little different simply because the Canadian markets are broker time priority versus the U.S. markets being price time priority. And I don't know if you looked at that in any way in the study. I didn't see it at all, no. But there certainly would be some impact with that. And I firsthand experience kind of watching the ebbs and flows of my order flow coming through the system with regards to that.
Yeah, You know, we haven't done anything like that. I'd love to maybe sometime chat with you.
Yeah, definitely.
Last question.
Yeah, so looking through the paper and then from the talk, I was trying to get an understanding of are stressful orders only aggressive or are they passive as well?
We don't, they could be either.
They can be either, because
They're just large relative to that stock on that day.
Yeah, on average, it's about 60% aggressive, 40% passive.
okay, and then because the other thing I wanted to, similar to what Chris just said, I know one of the comments was then HFTs over time can be more passive in the direction, so competing with the order. But if they're passive, they're clearly not competing with the aggressive. The aggressive would be crossing the spread, so it'd be different prices. But the other thing is, competition at the same price is different in equity markets because if that stressful order is coming from a broker, a non-broker HFT can't compete with them because their priority is so different. So even if they're at the same price, they're at a much different priority level, which really is the definition of competition.
All right. Thanks a lot. We'll start back at 2:40. There's coffee outside. Restrooms down that.